So some of these better solutions is a term loan. So borrowing a specific amount of money, it's going to have a predetermined term. So typically anywhere from 2 to 7 years, and then it's going to have a fixed monthly payment of principal and interest. And so the nice thing about that is you know exactly what you're paying every month. It's not like a merchant cash advance where that daily amount could go up or down depending on how well your sales are doing. It's a fixed amount. You're paying down the principal at the same time. This is really a better fit, in my opinion, if you're going to be using all of the money that you're borrowing for specific purposes. And so if you're going to be buying equipment, or let's say you have a big marketing campaign you want to handle and you're going to spend all that money up front, this is a great fit because it stretches it out over a longer term, so your monthly payment is less. Whereas on the flip side, in the next box, we have the working capital line of credit. This is a similar option in that you get the money for those same purposes, but it typically is revolving. So just like a credit card, you can use, pay down, and reuse that money as needed. Your payments will vary just based off of how much you've used. And so if you haven't used any, your payment that month is going to be $0. But it allows you to have that cushion to use the money when needed. And then you would pay interest only during that 12 months, which is the typical term for a line of credit. At the end of the 12 months, you can either pay off the full balance and close the line, or what's most common is just renewing that line of credit for another 12 months. So that's what most people do. It gives you that flexibility, but it's a better fit than a term loan if you don't know if you're going to use all the money, mainly just, again, because you're not paying interest on the portions that you don't use. So that can be a really good fit for a lot of businesses, especially in the situations like we've talked about, whether you're having a cash flow crunch. You might have an issue making payroll this month because you invested money into other business purposes, but you might not have that same issue next month. And so having it available when you need it, but then not having to pay interest on it when you don't, is certainly a big plus that both the invoice factoring and the merchant cash advances do not offer. So certainly two really good options. Some of the advantages with predictable monthly payments, the significantly lower cost. Origination fees are also lower. Most banks have an origination fee of 1%. Again, merchant cash advance, you're looking at 2 to 5%. So you can see how that adds up quickly depending on how much you're needing to borrow. 3 is the flexibility in how the funds are used. Term loans, and really it's going to depend on what your needs are and what your goals are. And then 4th is the lower risk. Bumps in the road or hiccups come, as they will with any business. You're going to have cash flow and reserves available that you haven't been just funneling into paying a merchant cash advance as those situations occur.